Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you Monday, July the 6th. The year's 2020. Let's talk trading. Trading step by step. Step one. I just want you all to know that these videos are for educational purposes only. Your results may differ from mine. Trading is extremely risky. You can lose all of your money. If you need trading, investment, or financial advice, seek the advice of an accredited financial professional. So, trading step by step. Somebody out there decides they want to trade. Where do they start? What do they do? Well, usually they go down a certain path and they learn things the way most people are taught, and then they get the results most people get, which is losing, which is lost money, blown accounts. So I just thought I should put together a little trading step by step series here. And as I mentioned before, I'm not going to talk about anything new, nothing that you haven't heard me talk about before, on and on and on. So, step one. What the heck is step one? Step one is risk management. And this is step one because if you get this wrong, chances are you're going to wind up blowing the account, your money. Okay, what is risk? Let's define risk as it's the dollar amount or percent of your account that you're willing to lose per trade. So, for example, if you have $1,000 account and you are willing to lose $10 per trade, 1% of your account, then you have to make sure you don't lose any more than $10 on any one single trade. So if you're trading at $1 a pip because you've chosen Forex, the Forex market to trade in, then your stop loss is going to be 10 pips. Because if price moves against you by 10 pips, you're going to be down $10. That's it. You got to cut your loss. No hoping it'll come back. No averaging in to double down. None of that. Nope. You are a beginner, a rookie. You're a newbie. You're learning how to trade. So this is your first step is risk management. Because if you get this right, you can stay in the game a long time. Or much longer than if you don't get it right. So think about it. If you risk $10 per trade, you'd have to lose 100 trades in a row to blow your account. You'd have to lose 50 trades in a row to have your account, cut it in half. Now, is it possible to lose 50 trades in a row? Of course. Is it likely? Only, as Dragon would say, only if you're an idiot. I'm just going to put that out there. Trading the methods that I show you, and that most people show you. Well, I won't say most. Let me say that some others may show you methods that it'd be really difficult to lose 50 times in a row. In fact, you could flip a coin. You flip a coin, heads you go long, tails you go short. And then, so whichever one comes up, if it comes up heads and you go long, that means you only take long trades. That's it. No shorts ever. So then you flip a coin again, it's either enter or wait. Enter or wait. You could do that. What's your chances of losing 50 times in a row if you're going long each time? You realize what kind of downward motion would have to happen for you to lose 50 times in a row? I mean, even if you traded on the 1 minute chart, I don't think you could lose 50 times in a row. If you traded at the open of each 1 minute candle, I don't think you could lose 50 times in a row. I don't think I've ever seen 50 M1 candles all red in a row. So you see, if you have that risk management right, it's going to be really hard to blow your account. So once again, risk is defined as the amount you're willing to lose per trade. It's either a fixed dollar amount or percentage of your account. Now, if you use percentage of your account, you should probably only adjust that maybe at the beginning of the week, preferably just one time. Adjust that at the beginning of the month. And so for that month, you say, I'm going to trade 1% of the account. So let's say it's $1,000 the first month. Second month, let's say you did pretty well and you actually gained 200 bucks. So now you'd be risking, for the second month, you'd be risking $12 per trade. And you just work your way up that way. Slowly but surely, steady growth. See, it really isn't difficult, traders. It really, really, really isn't. But, there's some people out there that they use big words and they make things more complicated than necessary and more complex. All these fancy formulas and stuff. And that's so to confuse you and then to make you believe that, hey, you know what, if you learn all this stuff, you too can be profitable and get that Lamborghini or Ferrari or new vet or whatever fancy car you want, or yacht or jet or all of them, all of the above, right? Well, chances are starting out with $1,000 account, probably not going to happen. You might be able to be like me and own yourself a few Miatas. But anyway, that's besides the point. The main point is that you set your risk, you have your correct position size and your stop loss placed accordingly, and that's it. If the trade goes against you, you get stopped out. Because one of the few things you can control in trading, not the only thing, because there are a few things you can control, but the most important thing you control is how much you lose. Now, of course, there's those unforeseen circumstances where the price spikes on a fat finger trade somebody somewhere else does or whatever, and you wind up losing more than you're willing to lose. But those are few and far between. They can happen. Just be aware of it. That's why I say these videos are for educational purposes only, and your results may differ from mine because it can happen. A bank could issue something, somebody could get killed, somebody could tweet something, who knows, and the market just spikes by, 20 pips, and you had a 10 pips stop, and you wind up losing 20 pips. That's just trading. It happens. Fortunately, it doesn't happen often. So, not to beat a dead horse, but that's risk management. That's it. That's step one. So let's go ahead and we can look at, the brain management. We'll be working on that. And just like we'll be working on money management, which, by the way, for some strange reason, I thought I had moved the money management to where it belonged here, but for some strange reason, the computer is not saving my profiles correctly. So in the money management, which we will get to later on, that's one part here. So for the week, we still have 1, 2, 3 gaps that haven't filled. Now, for the first day of the month here, you see price popped out, ran up, and came back within that first day of the month range right here. First day of the month's range. We're still working on the first day of the week. So you see here, it looks like you had a chance to maybe pick up about 30 pips. Just trading off of this horizontal line. And we will talk about horizontal lines in the step by step. And I'm sure any of you that have been watching my videos for maybe just even a couple would know that horizontal lines would be mentioned. Okay, for the month we're up 86. For the day and week we're up 25 since it's still Monday. But for the year we're down 760 from the yearly open, which you can see up here. That inside bar from 14 weeks ago. Still valid, still tradable. And you can see here, there was, right now, if you took that trade, you'd be up 11 pips. Once again, money to be made off of the inside bar trade. The range, strange day, only 5 pairs over 100, and seems like all but one are euro pairs. That's really interesting. We're right at the previous day's high, so price could either rocket through or turn right back around. But we're right there at the previous day's high, which is another nice breakout trade. On the daily, yesterday I showed we hit the pivot and we moved up and then we moved down. Rats, red rats had some feasting. In fact, I took a short at the double O here. I know it's a triple O, but I just ignore that digit. And remember, this is a double psychological. It's double O, so that's one, but it's also $1.25. That 25 is a psychological, so the double psychological. Range 62.3, so the range is large enough to trade the rat. But right now, we're kind of in no man's land between the two rat zones. I really wouldn't be looking to take any reversal trade here. Showed you yesterday we hit the monthly pivot, and that weekly pivot is down here at 124, call it 124.19. Switch this back over to H4. Weekly pivot, we've missed it. There's a 124.19. We look at the daily, we took it out. So you can see we still have one missed pivot this month, and which is down here. And we've got 2 missed pivots from June and 2 from March, and then one way back December of last year, 2019. Wick zone in and out. You can see here it came back in, went out, came back in, went out. So price doesn't like staying in the wick zone. You got a huge inside bar here. Huge. So just keep in mind for the rest of the day, just think about risk and how much you're willing to risk per trade. Now, if you're only going to risk $10 per trade, if you get a 1-to-1, risk reward, that means you'll take $10 per trade. And how long is that going to take you? And you're going to be happy with only making $10? There's something to think about. You make $10 per trade. Is that going to make a difference in your life? Is that going to make you happy? Or possibly, is that only making $10 a trade? Would that possibly make you overtrade because you want to make more money? But if you can make 10 pips, you can make $10 at $1 a pip. If you can make 10 pips on a regular recurring basis, then there's no reason you can't make $20, $30, $40, or $50 per trade and possibly make a difference. But we'll get into that down the road. I guess I'm getting a little ahead of myself because right now we're focusing on making sure you don't lose more than you're willing to lose. And of course, simple price action trading, candle color at the line. And you can see type what kind of pips or how many pips you could have made here. But fellow traders, I'm running out of time. So just remember, risk, you control it. Because it's not what you trade, it's how you trade it. So drain the banks and subscribe.